Good afternoon. Hi, I'm Gates Dunaway, and this is Margie Mesnett.
Hi, everybody. Welcome back for those who were with us previously, and welcome to those who are new.
Yes, thank you. We had an earlier session that started at 12 that was an overview session of this two-day webinar, and now we're going to get into the meat and potatoes of the webinar, which is learning more about what it is you have, the product you have, and the hurdles and the advantages you have to those products. This is lesson 2. Excuse us. This is a lesson on the Section 236 in the Beamer program and the requirements for prepayment permission from HUD. From the first lesson, we learned that there are 1,150 active 236 loans still out there, and that there's not been any new activity on these loans since 1973, and that many of these are owned by nonprofits. We also learned that for the 236 Beamers, there's only 30 that still exist across the country, and that they have some particular issues to getting refinanced and preserved. In lesson 2, we're going to go through these objectives. The first is we're going to recognize the potential benefits associated with mortgage prepayment and the refinance of certain HUD properties, these 236 and these 236 Beamer properties. We're going to identify 2 provisions that relate to prepayment. The first is Section 250 provisions and how they apply to the properties and the impact on repaying or prepaying your mortgage. Then we're going to also look at Section 219 provisions that may apply to properties and their impact on prepaying or repaying your mortgage. The last 3 objectives, we're going to outline the process for requesting prepayment approval and the timing considerations for that process. We're going to recognize that prepaying a mortgage can serve as a means to actually preserving your affordable housing. And then we're going to determine the potential impact of regular and enhanced tenant protection vouchers, which we call TPVs, on the ability to preserve your affordable housing. So topic 2.1 is the prepayment situations and benefits. So prepayment situations and benefits, in terms of preserving and sustaining your affordable housing, what types of situations could lead you as an owner to seek to prepay your existing mortgage? And what are some of the potential benefits of prepaying an existing mortgage? And this has come up when we were doing these workshops across the country. We had folks that thought it was counterintuitive that actually prepaying a mortgage would help you preserve it. But we're going to go through some steps here as to how there's actually incentives out there that in a prepayment situation, you're actually going to be able to preserve your property and improve it for a longer period of time. So going back to the questions of why prepay, the first one would be to take advantage of lower interest rates so that you can do large capital needs to your property, replace systems. You could reconfigure units. We're going to have a section where we talk about units that are perhaps obsolete today, but they could be reconfigured through prepayment and refinancing. You can improve your amenities, and of course you can enhance your services even through some of these prepayment options. The second is that you can replace current high interest debt with today's phenomenally low interest rate debt. And then you can re-amortize these new loans out. And you can basically re-leverage a brand new loan that can be used for mostly capital improvements. And then in certain cases, prepayment of a mortgage, you can trigger tenant protection vouchers for project residents. And that's an important tool that's only available, as Margie said earlier in the last lesson, to folks who prepay. So let's go right into the Section 250 of the National Housing Act. The question here is, can you prepay without HUD permission? If the answer to that question is no, then Section 250A applies to your property. And then what we're going to talk about is how Section 250A applies and what you can do. The first obvious question to ask is, how do you determine your prepayment requirements? The topic and the next provide guidelines for types of properties that are subject to Section 250 and then to Section 219. 219 is going to be for those who do not require prepayment permission. To determine or confirm if any other prepayment requirement is associated with your properties, it's recommended to check your mortgage note. And again, when we were traveling across the country talking to folks, the first question we would ask everyone is, do you know where your mortgage note is? Do you know where your regulatory agreement is? And if you don't, you need to find out where those are, because that's where you're going to find out if prepayment permission is required. Look for language in prepayment requirements within the note. And then, as always, if you cannot find your note or you don't know what it says or you can't interpret it correctly, talk to your local HUD office. They're going to have a copy of that note, and they often can help you interpret it. Section 250, again, this is repeating what I just said, that the surest way to determine if this applies is to check your mortgage note. And it should clearly state whether or not HUD permission to prepay is required. There's Notice H 2006-11 that provides guidance on the process for Section 250A prepayments. This is the first reference to a HUD notice that we've had. Again, you can go and find HUD notices on the preservation website, at the HUD website. You can also just simply Google this notice name, and you'll typically be able to pull it up. And we look at the notices as the baseline for the information needed to guide us on these processes. The types of Section 250A properties. So these are the types of properties for which 250A may apply, in which HUD prepayment permission is required. Some Section 236 and some Section 221D3 mortgages may require HUD permission. Some properties with rent supplement contracts would require HUD permission. And typically, all the nonprofit-owned properties would require HUD approval to prepay, and they are required to comply with this Section 250A. Some projects owned by profit-motivated owners are also required to comply. Again, we tell you, go back and look at your mortgage note to find out. Notice H 2006-11, prepayment request requirements under Section 250A. So this is the notice you would go to look for these requirements under 250A. You must notify the tenants of your request for prepayment approval through a letter at least 150 days prior to the request being made to HUD. After the tenant notification is filed, tenants have an opportunity to comment on the prepayment, and the comments are submitted with the prepayment application for HUD to review. The point of this process is to allow tenants enough time to understand and to comment. They must provide a copy of the tenant notification letter to the HUD field office with a signed certification that has been delivered to the tenants. And so you can follow your typical protocols for delivering notices to tenants in order to make sure that everyone got it, and they got it at the 150-day mark before the application is made. If the prepayment is being made to refinance and complete a rehabilitation of the property, the proposal must include a detailed description of the planned rehabilitation. So this is the first clue that in order to step forward into requesting prepayment permission, you must be understanding what it is you're going to do with the property. You aren't going to be able to prepay without typically a refinancing. So you will be showing HUD through this application your refinancing and your recapitalization strategy. And lastly, the owner must execute an appropriate use agreement in return for the prepayment permission. The use agreement ensures that the property will be maintained as rental housing for low-income families for at least the original mortgage note term and potentially beyond. There's a HUD process, of course, for evaluating these prepayment requests. The first step in this process is your lender is going to submit a request to HUD headquarters on a Form 9807. You complete the tenant notification requirements, which have a 150-day timing requirement. So again, you're going to submit your notification to your tenants 150 days before you're submitting your prepayment permission application. HUD headquarters requests documents from the field office to process that prepayment. And the field office is going to review it to make sure you've complied with all of those requirements. And then the field office completes a prepayment checklist and submits it as in the required documents to HUD headquarters. Continuing on, the Office of Asset Management completes the processing of the prepayment request. HUD headquarters works with the field to address any outstanding questions and to issue what they call a terms and conditions sheet. And then the lender is informed of approval of prepayment, and headquarters also informs, of course, the field office. It is important to note that this is one of many steps that could be a part of a refinancing strategy, and you must time things accordingly. So you must know when your 150-day clock must start if you're in a refinancing process, and then you must time it so that you're submitting your refinancing application at least beyond the date that you've submitted your prepayment request application. The documents that are required for a prepayment request application include the regulatory agreement. Again, you must know where this regulatory agreement is. If you don't have it, hopefully HUD has it. Mortgage note, the use agreements, if applicable, your original Section 8 HAP rent-sup or rental assistance payment contracts. If you have a flexible subsidy loan, which we're going to talk about in a bit, you would want to include the flexible subsidy loan documents. And then the deed of trust that shows the ownership of the property. So the rehab requirements in a 250A application include the following. The first is that your total hard cost must exceed $15,000 a unit. And hard costs can be defined as those costs that are required to renovate the property, all of the construction costs and related to that. The second is that you must include the replacement or modernization of at least one major system. And a major system is typically described as anything that's a whole building system. For instance, the roof would be a major system, replacing the windows would be a major system, replacing the HVAC units would be a replacement of one major system. And the last option is that your total hard costs must exceed or equal 25% of the total development cost. Total development cost are those costs that are inclusive of the entire transaction. That would be the cost of the renovation, the soft costs associated with the new financing and the interest in your architect, and also the payoff of the loan itself. So that was the Section 250 requirements. Now we're going to move on to Section 219. The question is, does 219 apply to your property? Section 219 applies to loans that can be prepaid without HUD approval, or they will be eligible for prepayment by right within the next 2 years. Technically, the owner can prepay without HUD approval as required, that would be required under Section 250A. But however, Section 219 does have a few important requirements. Under 219, you must also provide the 150-day notice, and if you don't, you are then going to be recording an extended use agreement for the property to operate at the same affordability restrictions up to the original maturity date of the mortgage. So 219 has the flexibility of not requiring tenant notices. However, if you don't do a tenant notice, then you are going to have to record this extended use agreement, which then would entice you to want to do the tenant notices so you do not have to have the extended use agreement. The following are some property 219 project types. The first would be 221D3 projects that receive project-based Section 8 as a result of conversion from rent-sup. The second would be a 221D3 Beamer projects, and then many of the FHA insured Section 236 projects. These should always be evaluated to see if 219 applies to them and if HUD permission is required. Again, there's a reminder here to always check your mortgage note for this. Let's talk about this 150-day notice that HUD has. Owners provide a prepayment notice to the tenants, to the local government, and to the local HUD office at the same time, 150 days prior to the day that they are going to submit the application for prepayment. Under Section 219, this notice expires 270 days after it is delivered to HUD. So this means that if you do not close your new financing within 270 days of that original notice date, you would have to reissue the notice. One way around that is that we found that people on the 150th day after the notice, basically the day that they submit their prepayment request, they would go ahead and reissue the 150-day notice to tenants. If the closing is delayed beyond the 270 days, the 150-day notice must be delivered again, as we said. So here's a little bit about the use of proceeds from the sale of a project by a nonprofit owner. This has gotten a lot of attention and a lot of talk as this is relatively new and could be very advantageous to nonprofit owners. HUD recently issued guidance, which is in the form of Notice 2011-31, that provides new flexibilities to nonprofit owners of Section 236, 221D3, and other FHA-insured properties who prepay their mortgages under Section 250 or 219 and then sell their properties to another owner. If the nonprofit sells to a purchaser who has experienced successfully owning and operating affordable rental housing, and that purchaser will sign a 20-year use agreement and 20-year Section 8 contract renewal, the seller, the nonprofit seller, can receive 100% of the net proceeds from the sale. And it's, to be clear, the net proceeds from the sale would be all those funds left over once the mortgage is paid off and all the transaction costs are paid. All the costs remaining after that can be retained by the original seller. This is an incentive to help nonprofits sell properties and safeguard them as affordable housing before they mature and lose their affordability restrictions. And as Margie talked, there's a bit of, there's a possibility that folks have what we would call deal fatigue. They've been owning their property for 30 years. Perhaps the original makeup of the board has changed such they don't want to own the property anymore. Prior to this notice being issued, if they had sold their property, they would not have been able to retain the sales proceeds. This gives them now a way to keep the sales proceeds, notwithstanding the fact that they must use those sales proceeds in keeping with their IRS 501c3 designation. They still must keep to that piece of it. So now we have two quick little examples. Hypothetical Property A. Hypothetical Property A, the mortgage is a HUD insured under the 221d3 below market interest rate program, so it's a Beamer. The property units receive Section 8 housing assistance payments for 100% of the units. The mortgage note, the mortgage does not have a prepayment restriction requiring HUD approval. And the owner chooses to prepay the mortgage prior to the maturity of the mortgage. So the question is, must the owner comply with Section 250A, 219, or neither? Margie, do you know the correct answer to that?
Well, thanks, Gates. Actually, I'd say that's a Section 219.
Right.
Because there's no prepayment restriction.
Right. And the third bullet's your answer there. Under the third bullet, it says the mortgage does not have a prepayment restriction requiring HUD approval, and as such, 219 would apply. So let's look at hypothetical property B. The mortgage is HUD insured under 236, 100% receives Section 8. The mortgage does have a prepayment restriction that requires HUD approval, and the owner wants to prepay the mortgage prior to approval, prior to maturity. So Margie, must the owner comply with 250A or 219?
I would have to say 250A because of the requirement to obtain HUD approval.
Right, under the third bullet. So obviously if it was the one, it was the other.
Exactly.
So now this brings us to our first case study. We should have opened up the workshop to let you know that we have really three methods of teaching through the live workshops and then through the webinar. And the first is, of course, the slide-driven instructional information. And the second are small activities like the one we just did. And the third are case studies, which have been turned into a method that we can hopefully get the point across to our virtual audience out there. So what we're going to do is we're going to read through the case study. I think, Margie, you're going to read this one.
Yep.
And together we're going to get to the end and answer questions together. And we will linger on some of the slides so that you really are able to absorb the information that's going to be delivered. So if we go to the slide, Margie, if you want to start.
Sure. And like Gates said, we had it a little easier during the live sessions because everybody there did all the work. And so this time we're going to try to mix it up a little bit so we can both give you a flavor for the background of the case study and then also what the suggested answers are, but recognize that throughout all of these case studies that there could be additional answers as well that we won't necessarily cover, and it's going to be based on the specifics of the property. So now this case study involves an apartment complex with an original HUD-insured Section 236 mortgage, which is scheduled to mature on June 1st of 2015, so not too long from now. And the current owner is looking to sell the apartment complex in order to generate the required capital to invest in other ventures. So what we're going to do in this case study is we're going to evaluate the property with the existing 236 mortgage from the perspective of the seller and the potential buyer and things they should be looking for. A little more information on this case study. The apartment complex has 80 units. 60 of the 80 units have project-based Section 8. The existing Section 8 contract expires on Halloween of this year.
Oh, that's interesting.
And then the other 20 units are Section 236 units with either the basic or the market rent for the 236 without Section 8. Families occupying the units are eligible to receive enhanced vouchers for these 20 units. The mortgage note does not include a provision for HUD prior approval to repay the mortgage. Okay, moving on. There's no use agreement in place that requires the owner to maintain the property as affordable beyond June 1st of 2015, which again, that's the original maturity date. The seller commissioned a rent comparability study with an effective date range of January 27, 2009 through January 27, 2014, so a 5-year rent comp study. And then the seller, who's the current owner, of course, proposes to prepay the Section 236 mortgage and subsequently sell the property.
Can I ask you a question?
If you must. No, I'm kidding.
No,
yes.
rent comparability study, we haven't talked about that. What might the rent comparability study reveal?
The rent comparability study, well, one thing, let me also explain that sometimes on purpose in these case studies, we're going to have information on there that you will definitely need to know, and you'll have some information in there just because we wanted to put additional information in there. It has no bearing, but in this case, I will say, to answer your question, that the rent comparability study is an important tool to have when you're talking about your Section 8 rents and in your contract, and we know that it's going to be expiring this year. So that's the germane part of why you need that. Okay, so speaking of adjustments, so after the sale of the property, HUD requires the buyer to use the original owner's initial equity and annual return on equity when submitting requests for an annual Section 8 rent adjustment. This is for a budget-based rent increase request, and we'll be talking a lot tomorrow about, OCAF, budget-based, markup to market, all of that. So this is only for the budget-based process, because this is a profit-motivated owner. If you recall, earlier we said that HUD approval is not required for the repayment, and I can't say always, but generally, when it's a profit-motivated owner, then HUD approval will not be required. But like Gates keeps saying, you have to look at your business documents to make sure. You can't assume. All right, so the profit-motivated owner, the buyer is entitled to all surplus cash at the end of each fiscal year. And when the Section 236 mortgage is prepaid prior to the sale of the property, the buyer would be considered a profit-motivated owner rather than a limited distribution mortgagor. Because, of course, you can have both ownership entity types on a 236.
Okay, so let's leave it on this slide for just a second to make sure everyone's got it. And then we'll move on to opportunities.
Okay, so getting into some of the meat of why we're doing this case study, the buyer must determine the advantage of purchasing a property with 80 total units, 60 of which are covered by the HAP contract, and 20 that are subject to market rate rents. And the main implication that we want to stress for this case study, there should not be any relocation in flight of the current tenants. Of course, we want to continue preserving affordable housing. So now, Gates, I get to turn it around on you. This is more fun than I thought. All right. What actions must the seller perform to ensure that they comply with the applicable HUD policies and prepay the existing mortgage? If the current owner does not perform these actions, what ramifications are likely to occur?
Okay, so the question is, what actions must the seller perform to ensure that they are to comply with applicable HUD policies? And this is a situation where HUD prepayment permission is not required. We don't think it's required. However, I would say as a seller, they would not want to be subject to the long-term use restriction that would come if they did not give notice. So the first thing that they would do is they want to give the 150-day notice, which it falls under the Section 219, so that they avoid the long-term use agreement. And if the owner does not perform this action, what ramifications likely to occur? So if they don't give the 150-day notice, they would then be subject to, they cannot do that. They would just then have to sign the long-term use agreement instead.
Right, and we'll talk about this a little bit in the next session, but another important reason is that you want to make sure that you protect the non-Section 8 renters with enhanced vouchers.
That's true, that's true. So what's the next question?
So the next question is, what due diligence should the buyer conduct in assessing whether it would be beneficial to purchase the apartments from a financial standpoint?
From a financial standpoint, it'd be most interesting to see the most recent audit, if they did an audit, or the most recent year-end financial statement, the most recent year-to-date financial statement. I would want to see their rent rolls to see if they're operating above typical occupancy rates, if they're having trouble with any vacancies. And then I would want to look at any of their contracts in place to see if there's anything in the contracts that would have an issue with the refinancing from a financial standpoint.
Okay. All right, let's go on to question number 3. What are the pros and cons involved in purchasing a partially a Section 8 assisted project? And keep in mind, this property has 60 out of the 80 units have Section 8, and the other 20 do not. If you were the new property owner, what action would you take related to the existing Section 8 contract that expires on October 31st of this year?
So the pros and cons involved in purchasing a partial Section 8 project. Of course, the pro would be relatively guaranteed income on those units, I would think. The con, I guess some people look at the con being perhaps the regulations and the compliance that comes along with the Section 8. If you were the new property owner, what action would you take related to the existing Section 8 contract prior to October 31st? I would probably look at that rent comparability study to see if there's an opportunity to mark the rents up to market, and then try to get a 20-year renewal so that I'd have a more guaranteed, a leverageable guaranteed long-term stream of income.
Okay.
Does that sound right, Margie?
That sounds right. I like it. I think overall, particularly if you're new to the HUD programs and you have to go through other processes, including getting pre-approved by HUD and everything, but just to be very familiar with the different options you have under the Section 8 renewal guide. And yeah, and hopefully you can do a 20-year renewal, which I love, so, all right. So moving on to the next question is, what methods and scenarios should be employed to evaluate proposed future revenue, expenses, and return on investments? And you touched a little bit on these, Gates, and when you answered number 2 on due diligence, but related to that.
I don't think I have much to add. I think that as an owner that's entitled to keep their equity at the end of the year, there is some return on investment formulas you could look at there. Okay,
that's it for our case study.
All right.
I think you did pretty good.
The sixth time is the charm.
I have to say, I've been fortunate to work with Gates, both in Chicago and Denver, and she's done a few more sessions than I have, but I'm a little jealous because she's younger than I am, and you could really tell when you look at her. We have our binders in front of us, and I have 2 slides on each page, and she has 6. So.
And glasses.
And glasses. Well, I've got my contacts on, so I think that cancels out the glasses, but all right. So moving on to topic 2.4, tenant protection vouchers. There is a slide here a little bit later that gives you the reference materials, but I will tell you in case you're curious, it's housing notice H2012-3, which was published by HUD in February of this year. There is a companion notice issued by Public Housing, and I have that citation later in there, but the bullets that you see in this section really come out of that notice. So let's start with a little overview. Tenant protection vouchers are meant to ensure there is no displacement of low-income residents when a mortgage is prepaid or rental assistance contract expires. And one of the things that you'll see when you pull the notice, I think it's actually quite good, it's very detailed. It talks about HUD has mandatory and discretionary authority to issue tenant protection vouchers. So for certain prepayments, HUD is required to issue enhanced vouchers, tenant protection vouchers, and then in other cases, like rents up, wrap, they have more discretionary authority, but the notice covers both types. Oops, got a little ahead of myself. TPVs also provide stability to the property, especially the enhanced vouchers. And then enhanced vouchers allow for rent payments above the local voucher payment standard to comparable market rents in order to allow existing families to remain in their units, even if the owner increases the rents. And why this is particularly important, when you talk about, normally you think of regular voucher and the payment standard is set by the housing authority, it's their payment standard and may or may not have any bearing on what the comparable market rents. Now in this case, the housing authority still has to concur with the comparable market rents for unassisted units, but they could have Section 8 vouchers in the same neighborhood as your property, and if you have an enhanced voucher, you may qualify for higher rents than the property next door. All right, moving on. When a mortgage is prepaid, certain mortgages, vouchers are provided to the unassisted residents. For example, if a project has 100 units and 40 are assisted with the Section 8 contract, the 60 unassisted residents may receive vouchers. Of course, they still have to qualify and everything, but that's an important tool that owners have to preserve affordable housing. The tenants are protected from potential rent increases. As an owner, you might also benefit from the additional subsidy that a tenant may bring to the property, because again, the vouchers will pay market rent levels. So let's talk about some of the covered conversion actions. And the notice refers to eligibility events, and that's very important when you think about whether or not they get an enhanced voucher or a regular voucher. So a couple of them that we have here, the tenants who are residing in the property on the date of these events are eligible for enhanced voucher assistance. Owner opt-out, so if the owner opts out of the Section 8 contract, tenants can get enhanced vouchers. And preservation prepayments, which is the topic we're discussing today and that we have been discussing this morning and early afternoon. Prepayment is a preservation method. Gates mentioned earlier that sometimes you don't necessarily think of somebody prepaying an affordable mortgage as a means of preserving the housing, but of course, it is possible to do that. And specifically, when certain qualifying mortgages are prepaid, HUD can provide affected eligible tenants with enhanced vouchers. And then we mentioned in the last session that if the 150-day notice requirement is not met, that owners can enter into a short-term use agreement. And a lot of that is not only to meet the 150-day requirement, but also to protect the tenants by getting them vouchers. Because when a mortgage is paid off on schedule or fully amortized, HUD cannot provide vouchers to the affected tenants. In this case, the role of the public housing agency, normally on a project-based Section 8 contract or a Section 236 or a D3, you're really working with your local multifamily field office or a contract administrator, either the traditional contract administrator or the PBCA. But in this case, when you have the vouchers, you're working with the housing authority. And housing choice vouchers are administered locally by the public housing agency. The PHAs receive federal funds from HUD to administer the voucher program. Now, sometimes when you have a conversion action, you could be in a small town and you have a nice-sized property, and the PHA really is not prepared to handle that many vouchers. HUD could reach out to another housing authority to have them administer the voucher. And of course, the rental units must meet minimum health and safety standards as determined by the PHA because they're the ones doing the inspections. So we have a little chart here that talks about the voucher payment process, and some of you may already be working with housing authorities, and you might have voucher holders in your properties already. But basically, this covers the role of the housing authority, the family who receives the voucher, and the property owner, the landlord. So the housing authority determines what the payment standard is. The tenant pays the owner usually 30% of their monthly adjusted gross income for rent and utilities, and there are some exceptions to that we'll mention in a minute. The PHA sends the owner the monthly payment, which of course they then receive. The families, they're required to comply with the PHA's housekeeping and other standards, recertification and all that good stuff. The owner is required to maintain the property in accordance with the property inspection in their HAP contract. And finally, as I previously mentioned, the PHA is the one that performs the annual inspection of the unit. All right, so now we have a few voucher payment exceptions. If the rent charged by the landlord is higher than the payment standard, the family must pay this difference. The most the family can pay is capped at 40% of its adjusted gross income. And sometimes families will choose to do this just because of, maybe it's a nicer unit somewhere else, or maybe it's in the school district where they want their kids to go, but they can pay up to 40% of their adjusted gross income and not the usual 30% that we're used to talking about. In specific situations, PHAs can issue enhanced vouchers that allow for rent payments above the local voucher payment standard to comparable market rent in order to allow the existing family to remain in their units as the rent increase. And it's also important to note that this payment standard that's higher than the local comparable, the rent is really based on the current condition of the unit and not as repaired. So if you're doing a big rehab program and then expect to be able to raise the rent, that's not what determines how the rent is set in this particular situation. It has to be the current condition of the unit. And then with enhanced vouchers, the family has the legal right to remain in their current unit unless the unit is undergoing sub-rehab or conversion to another use. That's different. That's for the enhanced vouchers. On a regular voucher, the tenant does not have the same right to remain. Now, I recognize there are, local jurisdictional issues and whether or not an owner can choose not to rent to a voucher holder, but there is a distinction between an enhanced voucher and the regular voucher. And again, the enhanced voucher, the tenant does not have to move and the owner must accept the voucher. All right, so this chart I really like a lot. It does come out of the notice, and this talks about the different events that enable HUD to provide tenants with vouchers. So if you look over on the left, the qualifying event, so the first one is prepayment of a 236 or 221D3 Beamer loan, except for nonprofit projects, and that's because the nonprofits don't have the right to prepay. So we're talking profit motivated, either PM or limited distribution owners. So in this case, the prepayment of one of these mortgages, the tenants who are income eligible and don't have Section 8 assistance are entitled to receive an enhanced voucher. The next example, if you have the termination or expiration of a project-based Section 8 contract, including mod rehab, which we have not talked about yet, the tenants who are income eligible and are currently assisted by the Section 8 contract, again, can receive enhanced vouchers. Our third event that I want to talk about is the prepayment or refinance of properties with flex subloans and a preservation transaction. The tenants who are income eligible and don't have Section 8 assistance can receive an enhanced voucher. And typically, for these flex sub properties, you're talking about a Section 236 or a D3 Beamer, or maybe even a 202 project that received flexible subsidy funding. And then the last one I want to talk about is the termination or expiration of a rent subcontract or a 236 RAP contract. Now, all the units on the original rent sub or RAP contract that were occupied during the 24-month period prior to the contract termination or expiration, those tenants received regular vouchers, not enhanced vouchers. And this change is something that came about under this administration because a lot of the owners are not billing for the full max of their rent sub or RAP contracts, particularly because there hasn't been any increased funding for those. So I think this is something that you preserve even more units than you probably would have thought possible, because it's all units that were occupied during the 24-month period prior to the termination or the expiration, not just the ones that are occupied at the time of your eligibility event. So moving on to voucher benefits, we have a few here. Tenant protection vouchers benefit the owner by helping to preserve occupancy stability during the transition from one financing mechanism to another. The resulting rent security helps create and preserve a short-term reliable income stream. And another one is the new program, the Rental Assistance Demonstration Program, RAD, as it's known, provides options to convert tenant protection vouchers to project-based vouchers where there's an expiring or terminating rent sub or RAP contract. This can draw new financing to the property because of the income stream to the project from the project-based vouchers. And again, this is a nice form of credit enhancement. If you want to know more about RAD, HUD.gov/RAD has a ton of great information on there and prior webinars that HUD has conducted on it. So that'll give you a lot of information there too. And then besides your benefits, you do have some challenges associated with vouchers. Portability is one of them. The tenant protection vouchers are tenant-based assistance, not like your project-based subsidy. If a tenant moves out, the assistant moves with that household and no longer provides income to the property. Units must pass quality inspection performed by the local housing office and must be maintained to uphold quality standards throughout the lease or the contract. I personally don't see that as much of a challenge. I guess if you have problematic tenants, that could be, but that's just a basic requirement, whether or not you have a voucher or you have some other form of subsidy. Then over time, voucher tenants are likely to be replaced with tenants who must be able to pull full rents without the voucher subsidy. The project is financed with tax credits, home, or other public funds. The incomes and rents of replacement tenants will be limited by these programs, so income to the project may be lower. So if your low-income housing tax credit rent is lower than what you were getting on the voucher, that's the rent you'll receive. All right, and I previously mentioned the tenant protection voucher notices. The first one you see here is notice PIH 2010-41. That's the public housing notice, which is the companion to the housing notice, which is shown there on your second bullet. Notice H 2012-3, guidance on eligibility for tenant protection vouchers following certain housing conversion actions. And that, again, is the one that we really pulled the information for this presentation on. All right, so that is bringing us close to the end of this module. I'm going to turn this over to Gates for our first review question.
Thank you, Margie.
And would you remind folks, or folks who weren't on the first session, how the review questions correlate with the pre and post assessment?
Yeah, there was a pre-assessment knowledge check that was made available to everyone who registered for this webinar, and we hope you had a chance to take that test. After each lesson, there are 5 or 6 questions, a couple of which you will have seen on that pre-assessment test, and we'll give you the answers here. Hopefully you have learned them already, and then when you take the post-knowledge check, you'll be able to answer correctly. So the first review question, which comes from the first part of the lesson, is which of the following is not a prepayment request requirement under Section 250A? 250A is the requirement if you do require HUD permission to prepay. So the first is you must notify tenants of the request for prepayment approval via a letter at least 30 days prior to the request. The second answer You must provide a copy of the tenant notification letter to the HUD field office with a signed certification that has been delivered to the tenants. The third is the owner must execute an appropriate use agreement. And the fourth is if the prepayment is being made to refinance and complete a rehab of the property, the proposal must include a detailed description of the planned rehabilitation. So the question is, which of these do not apply under the Section 250A? Do you have an idea, Margie?
I do. I'm going to have to say A, which is must notify tenants of the request for prepayment approval via letter at least 30 days prior to the request.
Because how long must they provide it?
It must be 150 days.
150 days. So it's just a difference in what it should be. It should be 150 days rather than the 30 days stated here. So the rest do apply under Section 250A.
Can I add, also in one of our sessions, I remember that one of the participants was saying, well, the tenants usually don't comment, and why do we have to do this? And, you know, it's a pain. And, well, one good reason, it's in the regulations. It's in the 24 CFR Part 245, but that's also an agreement that HUD had with the tenant groups out there, that tenants are going to be notified about certain important actions that could affect their lives. And when I worked at HUD, it was not unusual to have tenant groups protesting, you know, if they found out certain actions after the fact, or they're just concerned, even if they're going to be protected anyway. So that's why this is an important piece. Even if they're not going to be affected, you know, notifying them that this is coming is the right thing to do.
It's an important thing. Let's look at review question 2. Which of the following types of mortgages allows the owner to prepay without HUD approval as required under 250A? So 250A, again, is when HUD permission is required. So are those properties that are subject to Section 219? Is it those that are Section 221D3 properties? Section 236? And some properties with rent subcontracts? I think this is a slightly confusing question.
Actually, I thought it was
all right, we disagree. The answer is the properties that are subject to 219. So basically,
Right.
219 properties are those that do not require HUD permission to prepay.
Yeah, and I think that, you know, one of the reasons is because some of these, you could have a D3 or 236, some which might require
Right.
HUD approval and some which might not, so.
Right. Slightly
But you're
confusing.
right, depends on how you read the question.
Right, and you want to go do questions?
Sure, all right, now, let's see. Tenant protection vouchers provide several benefits, including helping to ensure low-income residents are not displaced when certain events occur, and providing economic stability to properties when they are transitioning from one type of financing to another. So here's the question. Which of the following events enable HUD to provide eligible tenants with enhanced vouchers? So option A is expiration of a Section 236 wrap contract. B is refinance of a property with a flex sub-loan as part of a preservation transaction. C is prepayment of a loan with a Section 221D3 mortgage insurance and a below market interest rate by a for-profit owner. And D is termination of a project-based Section 8 contract. So, you want to take a guess? I'll even give you a clue that
How many
there's
are
more
right?
than one.
Okay, that's a good one. So
Okay.
there's more than one right answer. I think refinance of a property with a flex sub-loan as a part of a preservation transaction would trigger this. Is that one of them?
That's one of them.
Okay, you're going to make me do them all? All right. Let's see. How about the prepayment of a loan with a Section 221D3 mortgage insurance and Beamer property?
Yes.
Yes, with a for-profit owner. And then the third, I think, would be the termination of a project-based Section 8 contract would do this.
Right.
Okay.
Okay. All right, so let's recap the Lesson 2 objectives that Gates started out with when we started this session. We had several. We wanted to recognize potential benefits associated with mortgage prepayment and refi of certain HUD properties, including 236 and D3 Beamer properties. We also wanted to identify Section 250 provisions that may apply to properties and their impact on repaying or prepaying the mortgages. The third was to identify Section 219 provisions that may apply to properties and their impact on repaying or prepaying mortgages. Okay.
We had this on the
I
last
think there's
one.
something, yeah. All right, let me just, I don't think I can. Oh, here we go. All right, there was a little timing glitch. Apologies for that. We wanted to outline the process for requesting prepayment approval and timing considerations. Also wanted to recognize that prepaying a mortgage can serve as a means to preserve affordable housing, which I think we did at length. And we wanted to determine the potential impact of regular and enhanced TPVs on the ability to preserve affordable housing. And with that,
Thank you, Margie. We are now at the end of Lesson 2, and what we will do is come back at 2:30 Eastern Time, I believe, to start on Lesson 3. And to recap, Lesson 3 is for those of you with 236 properties, where we're going to continue basically this thread of thought about how to preserve your 236 with a lesson on decoupling, and also we're going to touch on the flex subloan and the conversion of efficiency units to one-bedroom apartments. That will be from 2:30 to 3:30. We'll take a break from 3:30 to 3:45, and we will have our last lesson of the day, which is Lesson 4, which is on prepayment situations with the 202 properties. And that lesson will probably be about 30 minutes, and we should be able to wrap up by 4:15 today,
4:15, very
Eastern
good.
Time. So we'll see you again in about 30 minutes. Thank you.
Thank you.